Hi, good morning. You're watching The Market right here on 18 with me, Aisha Faridi, Aman Dabash, Anisha Jain in the studios. And for the markets, fortunately, the handover this morning is not looking all that bad, even though you've got critical US inflation data as well, which is awaited. But the global construct this morning is looking okay. Having said that, for our markets, we've been busy consolidating, or so we thought, up until session yesterday, and then came that big spurt, almost closing in on that all-time peak, made about near to that 19,500 print, and from there receded once again. But two of the important data points that the market is going to be eyeing out for, while the global markets are looking okay, Asia as well is holding out strong. Investors across the board have been eyeing the June Consumer Price Index reading. Pretty much across the poll, it is an indicator that it's going to be an uptick of about 0.3% from the month of May and 3.1% on an annualized basis. Excluding, of course, the food and energy prices, the core CPI is forecasted also to increase by about 0.3%. Now, why this is important is obviously because that's going to, in some sense, dictate or largely dictate what the Fed action is. The Fed, remember, has already indicated that there are going to be two more hikes coming in terms of interest rates. But yeah, this data becomes even more critical. Having said that, there is no problem across the world markets this morning. Like I said, Asia is also holding up in the green, across the board, while periphery markets like Korea are absolutely flat. Japan, of course, is a little bit of a sticky spot. That's down about almost 1%. Hong Kong holding up by about almost 0.8. And Shanghai is a little lukewarm. The handover from the US equity markets, of course, has been strong. It's a 1% move that you had in the Dow, and that equates to over 300 points. The S&P, the Nasdaq, the Russell 2000, they all held out okay. And the more important indicator, the CBOE VIX, that softened by about almost 1.5%. So let's see, important data. And that's going to dictate which way the markets head next.
Absolutely. And in yesterday's session, as you said, it was a day of consolidation. We wrapped up the day 0.5% higher or so at around the 19,439 mark. And when it came to the broader market, I would say a slight degree of outperformance was witnessed. All in all, the breadth was in favor of the gaining side. We failed, though, to sustain above that 19,500 mark in yesterday's trading day, and it was autos, FMCG that managed to gain, but financials, they were a huge drag in yesterday's trading session. So just going to point out then within the Nifty Bank Index as well, where the pain was felt, and it seemed to have been across the board, but the likes of a Bandhan Bank, for instance, Axis Bank, HDFC Bank was pretty quiet, ICICI Bank as well didn't pack in a punch. But incidentally, you had 6 stocks on the Nifty, which did manage to hit a 52-week high. So a lot of contribution coming in from the heavyweights. And the good news is that the liquidity continues to pour in as FIIs have remained buyers in the Indian markets for 10 straight days on the trot. So the kind of liquidity as well has been fairly encouraging. Yesterday, it was close to 1,197 crore rupees that they did pump in. But a big day, Anisha. I do not envy you because it's also a very hectic day for you because we've got big earnings.
Oh, well, yes, TCS and HCL Tech, and both will come post-market between 5 to 7 p.m. It's going to be a very, very hectic evening. But yes, the expectations are fairly muted, so I'm hoping that there might be a surprise because the worst seems to be priced in already. For TCS, we're expecting a paltry growth of 0.6% as far as constant currency is concerned. And remember, if you look at the last 9 to 10 quarters, the growth rate at least has been 2%. So there's a sharp reduction in growth rate now to just 0.6%, and that is important to watch. Of course, margins will be lower for TCS, but no surprise there on account of the margin impact. But look at the profitability as well. It's expected to decline, again happening after a very, very long time that on a sequential basis, we're expecting the profitability to decline. Ditto for HCL Tech, yes, the growth rate is going to be better than TCS because we're expecting a growth of around 0.9%. But there as well, the profitability is expected to come down sequentially. Let's actually pull up the trend lines if we can rather than just the numbers, because that will tell you the kind of reduction in pace that First up, let's pull up the constant currency trend as far as TCS is concerned, just to highlight the fact, as I was pointing out, that growth rate is now slowing to sub 1%, and this compares with over 3 to 4% that the company has been delivering. Even on the margin front, there has been a sharp decline that we're talking about, 23.4% thereabouts is what we are watching out for. Attrition rate continues to be high. The deal pipeline, at least this time around, will be okay on account of the big deals that they won. But the biggest question is going forward, what the commentary is. Discretionary spend has been coming down. There was a cancellation for TCS as well. Is this something which is expected to have a contagion effect or not? That will be critical. For HCL Tech, the key thing that I'm watching out for, apart from the fact whether they hold on to the guidance or not, because for now they're talking about a 6 to 8% growth on the top line with a margin band of 18 to 19%. The big thing, of course, there will be also the management commentary. IT services has been okay, but can't say the same about ER&D and the other segment, PNP as well. So a bit of a, mixed cues line. Stock of the, HCL Tech has already been declining for the last 4 to 5 trading sessions, so it's pricing in the worst already. Poised for a bit of a surprise, and TCS has been fairly steady. So let's see which way things go.
Yep, let's see whether IT can actually lift the momentum, or rather lift the somber mood that it has been in almost, I think, 2 quarters?
Yeah, it has been. At least the last quarter was very, very weak, and this is going to be same as well.
Okay, but in important news, last evening, the GST Council concluded its 50th meeting with the goods and services tax rate now trimmed to 5% in 4 items. In fact, the Council also exempted GST on several imported pharma products. However, one of the biggest highlights was the 28% tax rate which was imposed on full value of online gaming, casino, as well as horse racing. In fact, but obvious that this move has been widely condemned by gaming players. Let's hear out first what the finance minister had to say.
मन में गर्व महसूस कर रही हूं कि काउंसिल में आज बहुत ही इमोशनल तरीके से इसको कितनी दूर तक हम लेके जाना और कितनी दूर तक हम इसको समझना, इसके ऊपर हर स्टेट का भागीदारी रही और जो 2-3 साल से पेंडिंग है निर्णय, आज वो निर्णय हम ले पाए, इसीलिए कि हर स्टेट उसके ऊपर उनके अपने भागीदारी स्पष्ट रखे. There will be some amendment to the GST law to include online gaming also in it. Online gaming, horse racing and casinos will be taxed. They will be taxed at 28% each one, and they will be taxed on full face value.
Well, regardless to say that this move is being condemned by the entire gaming fraternity, and for instance, the co-founder and co-CEO of Games 24/7, Bhavin Pandya, said that he's quite distressed by the 28% GST on CEA as opposed to the gross gaming revenue. He says that the tax on CEA effectively creates a hostile environment. GST on CEA will render the legitimate online gaming industry unviable, will result in loss of taxes and outflows of foreign exchange, loss of employment for thousands working in this sector. And he's also saying that they urge the government to reconsider this intention. It's been quite the contentious one for quite a while, actually, come to think of it.
Yeah, and Ashneet Grover was just writing the obituary saying RIP the online gaming industry. And I don't, I feel for him given the fact that, the street was banking on that to be brought down, and there'll be a distinction between gambling, chance versus skill, right?
Yeah.
That's the whole contention that all of these online gaming industry guys were talking about.
Absolutely, and that's not there anymore. It's 28% uniform across GST on every category of online gaming. And yeah, they've all categorically said they're very unhappy. It's a huge setback for Indian players. It'll in fact discourage Indian players from playing, and even professionals, which will be burdened by this high tax. And now players could even move perhaps to offshore payments due to this decision. It's going to really impact their cash flows down the line, and they've all come out with, their views deeply condemning this move. That aside, we will be watching out for the reaction on the likes of a Delta Corp and Nazara Tech in today's trading session. But let's also keep it then with some market opinion. Where's the market headed from the current juncture? We spoke with Gautam Shah, founder and chief strategist at Goldilocks Premium Research, and he seems very optimistic on the IT sector. He believes that it's currently at an inflection point. Let's listen in.
I'm quite optimistic, to be honest. I just feel when I look at the ratio charts, which is IT index divided by the Nifty, it is at a 10-year low. So it just tells you that we are at an inflection point. Either it moves big from here, it sees a mega turnaround and does well over the next 6 to 12 months, which is actually my view, or if the breakdown happens on account of average or below average results, that would be a bit concern. But the way we study the charts, I think the downside potential is 5% and the upside potential is 20% for most of the top large cap IT stocks. So with a 1:4 kind of a risk reward at a 19,400, 19,500 index, IT is a buy from an investment perspective.
Okay, the GIFT Nifty indicating a flat start for us. Let's see which way the winds are going to turn for our markets ahead of that important CPI print that's awaited in the US. Most Asia markets as well, not a deep gash or anything, but they too are a little bit at bay. Naresh, hi, good morning. Welcome on the show. And, just wondering, each time that you think that the index is in consolidation phase, comes that big move towards mid-session or so. Was no different yesterday. I mean, come to think of it, we were only 20 points away from the lifetime high once again?
So extremely positive price action yesterday. And overall, if we see it, we are waiting for a pause, a consolidation. It is not coming up. The whole market is not obliging. Everyone wants a dip because it's oversold. And the market does not oblige fully at such times. But the fact is at 19,400, 500 levels, this reward for an index trade is off because there is a significant psychological resistance at 20,000. We have almost made a 600 pointer move after the recent breakout. So out here, the fact is the market strength tells you that the momentum is still strong. It is not getting into a consolidation mode. And in that case, what you do is prefer stock specific trades instead of the index. So the case is till the time we don't break any levels on the downside, the trend remains up. Whether we get into a consolidation or continue in an up move, both the cases are fine for a stock specific trading approach. So for now, 19,500, 600 is the resistance and 19,200 is the base. As we go higher, the base shifts higher. So the price action on the indices is pretty positive. You're seeing leadership come in few stocks. You have auto sector, which is doing well. You have Reliance Industries taking lead. And once after the next two sessions, we could get more clarity on HDFC Bank in terms of. So overall, the bias is positive. It's just that the risk reward is not great for an index trade. Time to continue to be stock specific and keep the bias on a positive trade.
All right. Given that you are looking at a very stock-specific strategy in the markets right now, I'm sure everyone's curious to know, Naresh, what's on your radar?
So the first stock is a buy on Sun Pharma. The stock has crossed a 6 to 8 month high. And over the last 6 to 8 months, this is one of the stocks in the pharma space which did not correct as much when the whole pharma pack was correcting. Finally, the stock has taken leadership by crossing that 1,070 mark, a new 52-week high for the stock. Expecting this momentum to continue towards 1150 to 1200 levels in the short term. A stop loss to be placed at 1050. Second is a buy on Ashok Leyland. The stock has consolidated around this 170 mark for the last 1 year. 1 year back also the stock paused at 170, went back to 135, 140 levels, came to 170 a few weeks back, again dipped a little, and now we are in touching distance of that 170 mark. And then if you go a little backwards, you have the highs in 2018 at 170. So huge classical cup and handle formation in the making of the last 5 years. Now, once this breaks out, this should ideally give a move which could be trending, very similar to what has happened with auto stocks one by one, wherein say M&M was placed similarly at 1,000 rupees when it started making a new 52-week high. And we saw a nice uptrend over the next few months. So out here, Ashok Leyland is in touching distance. The stock was ex-dividend by 2.6 rupees recently, so very close to that 170, 73 mark. Expecting this to eventually break out and take leadership in the auto pack. A buy at current levels, add more on the way up above 170, 72. Stop loss to be kept at 161. A short-term target to start with of 190.
Okay, so those are the top recommendations coming in from Naresh, but let's get stock specific and talk about a few stocks which will focus as well. PFC is one stock that has been seeing a stellar rally of late. What are the key things to watch out for? What's driving this rally and what are the key triggers to watch out for? Vamakshi is joining us with all those details. Hi Vamakshi, good morning.
Well, yes, Power Finance Corp in focus. The stock has in fact been in the limelight since the past couple of months, rising almost 61% on a year-to-date basis. And over the past year, in fact, the stock has managed to more than double. When we look at some of the factors that are actually aiding this rally is the macro stability, the Government of India's thrust, as well as the strengthening balance sheet of power value chain participants, which presents a robust lending story. In fact, Elara Capital expects the planned power sector capex to create a financing opportunity of almost 98,000 crores by FY30. The loan book, as a result, has finally started to pick up pace with a 133% year-on-year as well as 54% sequential rise in disbursements. The loan mix is also changing with a thrust on renewable energy as well as distribution. Not just that, the asset quality is also witnessing a remarkable improvement with GNPA coming in at nearly 3.9% for FY23, which is the lowest level that the company has seen over the past 6 years, and this has mainly come in on the back of resolutions of nearly 70,100 crores from FY20 to FY23. In fact, the dividend payout ratio was also quite healthy at 30% in FY23. So these were just some of the factors that could be aiding the rally. But what are some of the triggers ahead for Power Finance? Well, resolution of a few projects are expected to come in FY24. In fact, nearly 85% of their stressed assets are being resolved under the NCLT. Yields are also expected to expand, and that is mainly on account of upward revisions in prices taken in March 2023 as well as in December 2022. The analyst community also largely believes that the valuations are not fully pricing in strong growth as well as sustainable, healthy asset quality prospects. As far as the risks are concerned, higher haircut with delayed resolution as well as slower than anticipated demand pickup in project financing as well as liquidity schemes could result in slow loan growth. So those were all the positives as well as some of the risks that you should be mindful of, and as a result, watch out for Power Finance Corp.
All right, thanks very much, Vamakshi, for giving us those details. In fact, just taking note of the flashes that are coming in on your screen. This is, of course, with reference to yesterday's news of a 28% GST. Nazara Technologies on the Bombay Stock Exchange saying that the decision on online gaming, they would like to clarify that this tax, once implemented, will apply only on skill-based real money gaming segment of the business. And that contribution to their total revenues for the year FY23 stands at just about 5.2%. Remember, this is pretty much known in terms of Nazara that the contribution of real money gaming that they have is a skill-based real money gaming is just about 5.2% of the overall revenue pie. So that's the clarification coming in from the management of Nazara Technologies. No doubt, still, there will be some sort of an overhang on the stock price when it opens up in today's trade. Meantime, let's get in a view then on some of the banks. Yesterday, clearly, that was a pain point in trade. What's your outlook?
So the banks are consolidating around the upper end of the range. So if you look at first up, HDFC Bank has been sideways, 1550, 1600 on the downside, 1730, 1750 on the upside. Now, if you look at HDFC Bank, there is an event risk, and that is where we are seeing this slow and steady drift towards 1600 levels. But there is no trend. We are right in the middle of the range. So that takes away 30%, 25% of the Bank Nifty as of now. Then you have next is ICICI Bank, which is 10 to 12 rupees away from the all-time highs of 960, does not correct below 920, 930. So a classical consolidation at place around the upper end. Same is the case with Axis Bank around the upper end of the range. And same way, if you look at SBI, 600, 610 has been a resistance in the short term. And the stock has paused around those areas. At the same time, if you look at the smaller banks, you have a RBL Bank making a 52-week high. You're seeing a bounce in Federal Bank. You're seeing a great trend in IDFC First Bank, which continues to make higher tops and higher bottoms. The smaller PSU banks have hit new 52-week highs. So clearly, as of now, the momentum is more on the broader banking space rather than on the large cap banking space. So we wait for price action, a new 52-week high on ICICI Bank, or more clarity on HDFC Bank post this merger, and the stock starts trading for a couple of sessions. So for now, the banks as a sector are consolidating in a tight range, but the trend is not reversed just yet. We are not seeing, say, recent swing lows or weekly lows being broken. So for now, the bias is a consolidation going on in larger banks and the momentum to continue in the smaller banks.
Right. Okay. And all eyes today are, since we're talking about banks, are also going to be on that mega bank merger. HDFC Bank all set to dethrone Reliance as the new Nifty heavyweight. In fact, let's try and understand what does this mean for the company's financials going forward. Harsh is here to break it down all for us. Harsh?
Well, yes, so today is the last day for buying shares of HDFC Limited if you want to be eligible for getting shares in HDFC Bank, which is now going to be the merged entity starting tomorrow, the only listed entity between both of these behemoths, of course. And the combined entity is going to be, in terms of its financials, the effective date for the merger is the 1st of July. So it's already happened. So from Q2, you are going to see the combined number on the book. With regard to what happens to your shares, well, if you have 25 shares in HDFC Limited, you get 42 shares in HDFC Bank. If you have, for example, 20 shares in HDFC Limited, you get 33.5 shares. The half share you get as cash, which is the fractional element of the merger. So that's one piece of what happens to your shares. The other piece also is the fact that the merged entity is going to be the fourth largest bank in the world in terms of market capitalization. So it's going to be a fairly large entity, 22.5 lakh crore of advances on an accumulated basis. And of course, it will also have to adapt with regard to its ratios. Its deposits are currently lower, so that one change will have to happen. Also, going forward, its NIMs are going to come off. It's going to come down to around 3.7% odd. That's the expectation going forward. Also, loan growth is still expected to stay higher, around that 18 to 20% band. So keep your eye out on that one going into Q2 as well and going forward, because that will be the key expectation which will drive shareholder value going forward as well. Of course, 14.5% participation in the Nifty, 14.4% to be absolutely precise, and 29% in the Bank Nifty as well. So all of those coming through starting tomorrow, of course, as the merged entity goes through.
Okay, Harsh, thank you so much for joining in. HDFC definitely in focus, and that big merger will, of course, be effective on the exchanges tomorrow. LTI entry will come into the Nifty, and of course, HDFC Limited will stop trading. But talking about a whole host of other stocks which will be in focus today, cement as a pack is going to be in focus. There have been a couple of downgrades that have come in. Nomura and I think UBS as well. But this is usually a seasonally weak time for these cement companies as well. But structurally also they're seeing some problems, Somit?
Well, yes, Q2 is generally seasonally weak because of the rains. There is less of construction activity and hence less of cement demand. But what is more concerning for the cement space right now is that there was, for the last 1 month, there was a big buzz of a GST rate cut happening, but that played out in yesterday's GST meeting. Along with this, what the street is saying is that though demand continues to remain strong, the same strength has not been reflected when it comes to pricing. The pricing in the entire market continues to remain weak because though there is more demand, the competitive intensity in the segment is also high, and hence pricing is still comparatively weak in the cement space. Now, the recent run-up that we have seen in the share prices of cement companies, this was largely on the back of the fact that the cost part of cement companies were very on the lower side because petcoke prices were continuously declining. But what analysts are now suggesting is that the RM prices or the raw material prices for the cement companies have largely bottomed out now, and going forward this could rise. So if this cost side increases for the cement companies, and given the fact that prices are not increasing, the margins could lead to a further decline going forward, and that is what the street is expecting. Along with this, what they are saying that companies are continuously announcing capital expenditure plans which could lead to more capacity coming in the industry, and these capex plan would also keep the ROCE of these cement companies under pressure going forward. Also, the valuations have now become expensive. All major cement companies are trading above their 5-year average EV to EBITDA. Now, for Ultratech Cement, if you see, the valuation stand at around 17.3 times. That is a 12-month forward, and the last 5-year average valuations were close to 15 times. Similarly, for Ambuja and Dalmia Bharat, the 12-month forward valuations or EV to EBITDA is trading at a premium compared to their 5-year averages.
Okay, that's interesting on cement, but I think Ultratech has got the maximum amount of downgrades in the last few weeks itself as well. So that's something
That's
to watch
also the
out for
most
as well.
expensive cement place.
Yeah,
Hence
exactly.
the
And then
downgrades.
Tree
Largest.
Cement.
Yes.
Tree Cement is going through its own MCA issues with a lot of those clarifications coming, but the street not buying. So definitely not the best time perhaps to dabble into the cement names at this point of time. Perhaps you'll get better value later. But the other thing globally is also how the crude prices have inched up. In a matter of 2 to 3 days, it was trading at what, 74, 73 last week? Yeah.
Nearly 11% from their lows at around $80 per barrel level. Now, this is kind of negative for the oil marketing companies like IOCL, BPCL and HPCL, and the major reason behind this is the fact that there are expectations of a cut in retail fuel prices, and this, given the fact that crude prices are rising, would not bode well for these oil marketing companies, because the higher gross marketing margins that they were currently earning could come down going forward. So that is one of the bigger concern coming in for the oil marketing companies. But the pure play refiners here, that is Chennai Petro and MRPL, could really benefit from this, given the fact that they do not have any marketing exposure. And on the other hand, if you see, the Singapore gross refining margins are continuously rising and currently at around $5.5 per barrel level. And this is on the back of rise in all the product cracks. And also these companies have been getting a cheaper Russian crude. So the segment performance could be much better, and hence the street could be shifting towards the pure play refiners like MRPL and Chennai Petro at this time.
Okay, so that's a take coming in. But what about the entire gaming universe? So, of course, before I come to gaming, Samad, what's your take with respect to PVR and the entire multiplex? Because 5% is something which is beneficial for them, right? But is it something which is a big kicker for financials as well, or just a sentiment positive?
It could be just a sentimental positive, because at this moment also, as PVR said earlier, that they were charging 5%
already.
So it's not going to change much of a game for these companies.
There's a caveat there. I don't know if you've delved into the details or not. That higher tax is still applicable if you online buy while your ticket, you buy a meal combo and you book it while buying your ticket. So they don't want you to go through players like a Paytm, etc.
Or Book My Show.
But if
for
you
that
directly, or a Book My Show or any others, but if you directly buy it off their F&B kiosk inside the multiplexes, then it will be 5%.
Well, yes, that could be. I have not looked at that, but I don't think there would be a higher percentage of footfall of people buying online food at this moment.
Maybe. I don't know about that, but it's pretty much like aviation. With your ticket, you book your meals.
Exactly.
So, yeah.
But when it comes to Nazara and Delta Corp, for
That's
Nazara it could be
negative,
limited,
right?
because
5%.
they also came out with a statement saying that 5% exposure that they have on the EBITDA front, it's close to 10%. But for Delta Corp, if you see, it's nearly 95% of the total revenue coming in from casino and skill gaming. Now, why this could be negative? Because, say simply, if a person buys 100 rupees of chips, the GST that they have to pay on this is 28 rupees. So, and if there are winnings of around 50 rupees, they have to pay an income tax of 15 rupees. So, this 15 rupees income tax plus 28 rupees GST cost you nearly 43 rupees on winnings of nearly 50 rupees. So, the net gain for an individual would be just 7 rupees. So, this could be detrimental for the casino and skill gaming industry at this moment, because the taxes seem to be a lot higher, and also do understand the fact that 50 rupees winning on 100 rupees investment is also a very high probability. So this could be sentimentally negative. Obviously this will be sentimentally negative. We'll have to watch out for whether there could be any pushback on the taxes front.
But I don't know people who are addicted to gaming, and there are a lot of people whom I know who are addicted to online gaming. Will they stop playing or not? That's something which I really want to do a dipstick survey about. Maybe we'll try and do that and get you more details.
The industry view is that it will discourage them from playing, God knows.
But they'll find other avenues.
Yeah.
I'm sure, there are other sort of gaming portals or platforms which are available for free.
Yeah,
There's
I'm
always
guessing.
an option.
And we Indians are known to find our jugars, right? So let's take pride in that, and let's see what happens. But just wanted to quickly highlight the Citi note as well with respect to the consumer basket, because there's a bit of a downgrade which has come for a couple of these companies, the likes of Titan as well as Pidilite. Beg your pardon. With respect to Pidilite, they have downgraded it to sell from buy. The target price has been cut to 2,220 and 2,880 was the earlier target price. They say that the valuations are factoring in the margin expansion benefit, and Titan 2 downgraded to neutral from buy, but the target price is around 3,280, saying that the upside is capped.
Yes, that is a stock that we would be watching out for. But also, Samit, on the radar is going to be IndusInd Bank today.
Well, yes, given the fact that the shareholding pattern came out yesterday late evening, what we are understanding from that is the stock was a probable inclusion in the MSCI in the August review, but given the shareholding pattern, the foreign standard of the foreign room for inclusion has actually come down. Now, for MSCI inclusion, one needs to have a foreign room of around 15%, but what IndusInd Bank shareholding pattern is disclosing that the FPI room is just 13.5%, which means that IndusInd Bank would not get now included in the MSCI August review. Now, the street expectations was IndusInd Bank could be included in the August review, and hence there could be some position that investors might have taken on the back of this front. So we could see some negative impact on IndusInd Bank share prices today, given the fact that it won't be getting included in the MSCI August review going ahead.
Okay, let's move on. And since we can't take our eyes off or mind off from gaming, let's get on board N. Kumar from Prime Securities, considering he's also pretty much in the same boat. He tweeted last evening itself saying that the current GST proposal on online gaming can be best summarized as under. And for that under, I'm going to speak to him and get him to speak exactly what his tweet was. Jakes, hi, good morning. Great to have you on the show. I'm just taking a leaf from what Ashneer Grover actually tweeted, saying RIP. He's saying real gaming industry, if the government is thinking people will pay 100 to play on 70 pot entry, it's game over for the gaming industry. What are your thoughts on the same?
Yeah. So I think, hello, can you hear me?
Yes, I can hear you, Jakes.
Yeah. So I think it's a pretty straightforward thing that earlier on what used to happen, just to put this in the context of the current practice, was that if two persons, should I say, put in 100 rupees each in order to play a game, on their winnings, the platform would actually pay out 18% as GST, which means that if the platform earned 15% on 200, which was say 30 rupees, and on 30 rupees they'd end up paying 18%, which is 5.4 as GST, which collection broadly took the aggregate collection of the industry to almost 25,000 crores from what I understand, nearly 2,000 crores a month. Maybe the number is higher. I'm not even sure because a lot of the games don't get covered in the coverage that we have. But essentially what has changed now is now the GST is sought to be imposed on the entire 200, which is 56 rupees. Now, take it as a parallel to the broking industry, which people understand. The stockbroking industry has GST, has securities transaction tax, etc. built in. And all of these operate at sub 1%. In fact, well below the 1%, including the brokerage. Any industry in the world that can operate at 28%, that's the question that you need to ask yourself. Which industry? And here what's happening is when two people contribute 100 rupees each, literally instantly 56 rupees is taken away from the pool. There is no business in the world that gives the ability to pay out 56 rupees on 200 or 28% on in minute one and yet be productive or yet be able to operate in any manner, shape or form. So my personal feeling is, and if you add to that the winnings, which includes the income tax on winnings, etc., you end up in an absurd scenario where people stand to make 10 rupees, but almost certainly stand to lose 100 rupees. In addition to all this, if you take the general community punting, as people call it, which is that in the stock market, whether it's day traders or it's gamers, out of 100 people who play any kind of games, about 89% lose money, 9% break even, and 2%, if that, make money. Now, when the win rate is so low, and then you have a 28% imposition of tax on the entire pool, I mean, it's pretty logical that there is no chance in hell that anybody will make money. It will be very difficult to find people playing. Never mind the fact that there may be people addicted and, there are people who are sort of, this is like the daily habit, if you will. But there's no chance that anybody can play at 28% brokerage.
Yes, indeed. So, given that you very clearly spelt out the ramifications of this, what does this do to the industry? Because do you think now it's just going to shift everyone to illegal betting platforms in order to, in order to avoid this hefty GST, and thereby that will lead to a loss of revenue for the government?
No, there's no chance of illegal betting, etc. I mean, first of all, any illegal betting I can't comment on, number one. And number two, illegal betting, etc., is by definition illegal and therefore unlikely to, feature in any conversation that we may have. But I think what will happen is definitely these online games, these money games will almost certainly have a complete collapse of their revenues, unless, of course, logically, the government changes it. In fact, the expectation was that the 18% on winnings that the platform pays out should actually become 28%, given that there was a fair collection that was happening. And government sought to maximize this by saying that this should not be 18, but should be at the highest end, in line with quote-unquote a sin industry, if you will. Now, the fact is Supreme Court has held that some of these were actually games of skill rather than games of chance. There were nuanced differences that were being set out. And yet in one fell swoop, all these have been classified as 28% leviable on the entire kitty. My own personal feeling is it's retrograde to the extent that this genuinely, it's only a mythical thing that this 28% is seen as collection, because there will be no collections. That I can absolutely assure you.
Right. That is the whole point, Jakes, because there was that hope that there is going to be a distinction between a game of skill and a game of chance. You think there is a remote possibility that the government may actually go back to the drawing board, as has been the case in the past as well, and maybe make that distinction, and then sort of, that would act as a breather for the industry?
Well, I would say that the government, or the GST Council will do what it takes to protect the GST kitty. That there's no doubt about. When you say go back to the drawing board, whether they make a distinction, I think any game where 28% is charged on the kitty will by definition not survive. I think what needs to be done is definitely we need to start by making a distinction between a game of skill and game of chance, which the Supreme Court and the government have both held is a difference that needs to be pointed out. Maybe they start off by making a difference between the two, and game of skill is, you go back to 18% going to 28% on winnings for the platform. I think so. Just to put things in perspective, from a platform perspective, whatever they make, they pay GST and income tax on. From an individual's perspective, whatever he puts in, he pays tax on his winnings. I think that's the way it's been so far. That's been, to my mind, the correct way. We can argue whether the tax should be 18% or 28%, but that the government or the GST Council has chosen that to be 28. I have nothing to quibble against that. There could be a marginal drop-off if 18 became 28, or marginal hit to the profitability of some of these companies. But that is a matter of debate. That is not to strike at the very root of the problem and say we'll charge 28% on the entire kitty, I think is the issue here.
Appreciate your time. Thanks very much, X, for giving us that clarity as to what the implications of this could be. A huge blow, of course, for the online gaming industry. Tell you what, we'll slip into a very quick break with news that the GIFT Nifty is absolutely flat. Come right back with stocks and news.
को पावर्ड सेंचुरी प्लाई क्लब प्राइम, रहो बेफिक्र।
टिप पैसा लगाना है तो सेंचुरी प्लाई क्लब प्राइम पे लगाओ। डूबेगा नहीं, चलेगा भी नहीं, कोई खा नहीं जाएगा और मिनिमम 30 साल का रिटर्न देगा। अब इससे बेटर इन्वेस्टमेंट है तो बताओ। सेंचुरी प्लाई क्लब प्राइम, रहो बेफिक्र।
Thanks for staying on with us. Lots of stocks that will be in the spotlight today, and is an Economic Times report that says that ITC's Sanjeev Puri, the company could likely take a shareholder vote in the AGM next month talking and debating about whether or not there's going to be another term. The company will be voting on the reappointment of the chairman managing director on the second term for 5 years effective July 2024. So that, of course, is the latest Economic Times report on the same. They have said that, in fact, they will be voting on the second term of the 5 years, and they will be also appointing the food business chief, Malik, as the whole-time director. The company's 112th AGM, that has been scheduled for the 11th of August. So a big question mark, as now ITC is proposing a second term for the chairman managing director. So the vote will be taking place. In fact, just recently we spoke with Sanjeev Puri, and he was talking about the roadmap for ITC. He explained why FMCG is going to be the next big growth driver for the company. Let's just revisit that conversation.
We believe that this will be certainly be a lot more value accretive with passage of time. We have seen in the last medium term itself that not only has the today our size is 1.5x of pre-COVID. Over a medium term, our margins have expanded by 770 basis points. ROCE has gone up by 1,340 points. And we are not there. We are not done as yet. The journey continues. We believe that we will expand margins by, our aspiration is 100 basis points every year. So there's a lot of opportunity there. And we have laid a strong foundation with our trademarks, with our innovation capability, with our digital capability, with our distribution highway. We have not really.
Okay, let's welcome on board Dipan Mehta as well as Kunal Bothra too joining in right now. Dipan, hi, morning. Good to have you on the show. Can't help but talk about the new GST rejig which was announced last evening and gaming. I mean, is it really literally game over now for the likes of a Nazara and Delta with that 28% tax which has been slapped with no distinction between game of skill and chance?
Good morning and thank you for having me on your show. I don't think Nazara is impacted as much. I think management has come and said that their revenues are about 5% from gaming and EBITDA contribution is 10%. So from that point of view, Nazara has been conservative and they have avoided getting full on into this real money or any other form of gaming products per se. And another, I think, strength of Nazara is they are not focused or not concentrated in any single product or any single in the gaming industry. And even geographically also, they are quite well dispersed. So from that point of view, I don't think it's going to get impacted. Of course, it will be sentimentally negative for Nazara. And to an extent, I think the kind of opportunities which they could have pursued, that certainly kind of narrows down for them. But from an absolute result or performance perspective, I don't think the impact will be much. But yes, sentimentally, certainly going to affect the Nazara stock price. Delta, I think, is another cup of tea altogether. And this may hit them really hard, waiting for the management's comment on how they react to this particular development, because it speaks about 28% on the chips which are purchased. But, there can be ways of, working around that thing as well. Considering that, the chips return, what about those? How is that to be considered in the tax perspective? So waiting for a kind of a response from them, and then we can evaluate. But sentimentally, it's negative for both stocks, and you may see a slam dunk, a downward tick for these companies.
Dipan, the question is, will you buy that slam dunk? Would you use that opportunity to buy the likes of Delta and Nazara? Because as you pointed for Nazara, it might be a lot more sentimental rather than actual because it is just 5%. And Delta also a good buying opportunity perhaps?
No, not really. I think, I've seen in past situations like this when there's so much of adverse news flow and so much of uncertainty as to how the consumer will react to these kind of a tax structure, it's better to just stay away for 2-3 quarters. Let the dust settle down. Let us see what the real numbers are and how the impact has been, and then take a call. It's not that both these companies had were on a phenomenal growth path and generating 50-60% type of growth rates and were in the center of the entire gaming revolution which was taking place. So from that point of view, I just want to wait and watch. Nazara in any case is very, very expensive considering its traditional like price to earnings or price to book ratio. And again, they want to go ahead and raise capital and dilute equity as well. So that's another aspect to consider. So I would avoid both these companies, although as a disclosure, we have investments in both Nazara and Delta. And I think I'll have to take a bit of a knock on that holding over there early in the morning today.
Thanks so much for making that disclosure. So, yes, guys, even Dipan has been invested into both Nazara as well as Delta. But what he's suggesting is don't try to get the FOMO and buy on lower levels. Just take a conscious call as to what you want to do, whether you're holding it for the short term, whether you want to wait for the long term, and then take a decision. In fact, just wanted to highlight that apart from Nazara and Delta, you also have Onmobile, which will be in focus, as well as Zensar Tech. Both of these companies also have exposure towards the online gaming business, so watch out for these two as well. Dipan, that was about a couple of those gaming names, but what about the IT sector? I'm guessing you hold TCS as well. If not HCL, what would be the expectations there?
Yeah, I think I own a lot of IT stocks, and I'm prepared to ride out this soft spot or the soft quarter which they are in. I remain fully committed that the long-term prospects of the IT industry are fantastic. They are certainly improved with the advent of AI and ChatGPT, and all the more of those kind of projects may come to these companies. So it seems to be like a new tech wave for the entire software industry. And it's just a matter of time that tech spends start to improve once the kind of macroeconomic headwinds recede. So very positive on the longer term prospects, and the time to sell is frankly gone as far as a lot of the tech stocks are concerned. They have corrected significantly from their highs as well, the large cap ones at least. So you just have to wait out this soft period. I've seen many such points of time in the history of the software industry where they go through such phases where the growth is flat, slightly declining, and then it just comes roaring back as well. But I think my concern is more on the mid-cap IT stocks, the likes of, say, Tata Elxsi or Persistent Systems, KPIT, Coforge. I think they are trading at very rich multiples. And any kind of miss on the earnings over there could have a very extended adverse impact on their stock prices. And we are invested as a matter of disclosure in all of these companies as well. So I'm just bracing myself for a tough quarter when it comes to software, and I will maybe react in terms of an opinion on these stock prices once the actual numbers are out.
Yes, indeed. That entire space as well will be closely watched out for. And recently as well, we did have some downgrades as well coming in from JP Morgan on the entire mid-cap IT sector, in particular L&T Tech, Persistent, KPIT Tech, as well as Tata Elxsi. And they were talking about, as of now, how the ER&D spends have been slowing down the last 6 months, and that is structural in nature and not cyclical. But that aside, Dipan, wanted to get in your take on the entire cement space, given the fact that now analysts believe that demand continues to remain strong, that lower costs as well are coming in as a positive. Do you think that perhaps the only major concern for this sector would be valuations, which continue to remain very high?
See, my view on cement has been negative for a very long time, but I certainly feel that there could be a trading rally in cement when numbers are announced for the June quarter. It could be a strong quarter. Volumes have been holding up pretty well, and definitely benefits of lower cost will accrue to the industry. My issue is that the longer term prospects seem a bit blurred considering the kind of capacity expansion which is taking place. So there is real risk of a glut, and that could lead to depressed prices. That is one. And secondly, I think that overall, over a longer period of time, we see multiples compress as far as the cement industry is concerned, as ROIs also drift lower, and the kind of price discipline which was there for the past several years, that may get vitiated with the entry of new players in the sector as a whole. And I see better opportunities within the cement consumers. I mean, look at the way the real estate companies have been reporting pre-sales and new projects, and the way engineering and construction companies have been reporting excellent numbers and bulging order book position at decent margins. So from that perspective, I feel more comfortable in the cement consumers than the cement producers.
Talking about the real estate pack, today as well, there was a fresh HSBC note. They've actually raised their recommendations on both Prestige Estates as well as Sobha. Both are now at buy now. The price target for Prestige is 720, for Sobha it's 730. And Prestige, of course, also had that news flow regarding the land that they have bought from DB Realty in Mumbai itself. And that's expected to be another prime property that they would be launching. But within real estate itself, Dipan, does the preference lie?
Oh yeah, lots of choices in real estate, and you could really pick and choose. All of them are having a great moment at this point of time. The entire sector has livened up phenomenally, and depending upon your risk appetite, you could look at, if you are highly risk averse, then Godrej Properties, DLF, Macrotech, offer some comfort considering the size, the balance sheet quality, and the diversity of their projects. But there's a lot of value in companies like Shobha as well as Prestige, and this particularly new, project of theirs could be quite a big contributor to the revenues, considering that real estate prices in Bombay, especially that the premium level, are at record highs, sky high levels, I would say. So from that point of view, it opens up an opportunity for Prestige and provides them a foothold in the, I would say, the richest real estate market in India, that being Mumbai. So very positive on all real estate companies, but 3 or 4 which we track, which I feel more comfortable about, but I'm sure there are many others as well, which should report very good numbers going ahead.
Okay, so by and large, bullish on the entire real estate space. Let's welcome in Kunal Bothra as well, who's joining in on the charts. Hi, Kunal. First up, let's get your top picks going.
Good morning, Avan. So I'll go with a couple of buy calls over here. And the first one is actually a buy on Sun TV, expecting the stock to get into a very strong breakout mode. So for the first time, I think you're seeing some positive signs emerging on the charts for Sun TV. The stock breaking out of its major resistance around the 450 to 455 mark. So would suggest a buy with 494 as a target for Sun TV. Stop us at 464. And the second would be a buy on KEI Industries. Again, a classical chart, has been a consistent performer over the last so many years. Even on the short-term basis, the stock is coming out of a minor consolidation. So would expect a breakout for KEI Industries and an end of a minor consolidation, 2450 as a target, and stop us at 2200.
Okay, there you have it. Those are some of the top calls that Kunal is recommending. But Kunal, let's also get in a take on some individual names on the charts then. You've got the entire crude basket that will be in the spotlight, largely on the back of the fact that crude is nearing close to $80 per barrel. How are you looking at the charts of an MRPL or a Chennai Petro basis, the kind of move that they've seen?
So, most of these stocks like MRPL, for example, in the last 2-3 months, when we look at it from the March end lows, these stocks have done exceptionally well. From 60-65 rupees, MRPL has gone into a strong rally mode. I think 90 or 91 was the high for MRPL. The stock had made last week or so. So it's been a phenomenal rally for these stocks on the back of what happened to the crude oil prices from the 2022 peak. I would believe that there could be some tapering off of gains for these stocks over the near term. But in terms of support patterns, I believe, for example, for MRPL, 75 to 80 is a huge band of support for the stock price, where the volumes had jumped up higher. We look at the VWAP support for the stock prices, both in terms of volumes as well as the weighted average in terms of prices. So that also lies closer to 75, 77 mark for MRPL. That's again a very good territory. In case the stock happens to correct and come back to those levels, that could be a very good classical re-entry point or the mean reversion point for MRPL for traders who are looking to buy. Chennai Petro, on the other hand, I think closer to 400, 420 is a strong support zone for the stock price. It's a more of a steady stock as compared to a stock like MRPL. Chennai Petro has been a stock which moved from 300 odd levels to now 440 odd plus mark for itself. Again, classical volumes, very steady kind of chart for Chennai Petro. 420 could be a good entry point in case the stock dips to those levels.
Okay, I just wanted to get in a take as well on Reliance Industries from you then, Dipan. Given the fact that after the announcement of the Jio Financial demerger, we've seen the stock close to an all-time high. What's your outlook on Reliance Industries?
So I think it's playing catch up for one, because it had been underperforming for the past several weeks or so, and this demerger has put the focus back on Reliance, and I think a lot of value has got established as far as Jio Finance is concerned, as we have become aware more and more of the financials and the balance sheet status of that company. But the clear question in mind is what is going to happen with the other larger businesses, that is Jio Platforms and Reliance Retail. Are they going to go the Jio Finance way, where shareholders will get free shares, or are they going to go for IPO and Reliance becomes the holding company? I think time is ripe to answer that questions on the part of the management, and maybe they are thinking also on those lines. given that, three very distinct and disparate businesses are there in a single company, and that, is not completely attractive to investors, because investors may want specific exposure to the tech business or the platform business, but some may prefer to buy the retail business, and the value investors may want to look at the refining and the plastic business. So having it all combined in a single entity makes it less attractive to investors, but having separate listings certainly will attract a lot more players into it. But how that separate listing going to take place is the big question mark. And going by Jio Finance's kind of a demerger, I am hopeful that we could have demerger of the other two divisions as well, which will be a huge value unlocking opportunity for the minority shareholders.
Reliance has become more of a value unlocking and a special situation kind of stock rather than just the fundamentals. But Dipan, what's your view regarding PVR Inox? The stock has been quite beaten down. Of course, there was a bit of a relief coming in with respect to the GST rate for F&B being decided at 5%. But then there are a slew of losses lined up. Today, of course, there'll be Mission Impossible that will come out. There's Oppenheimer, there's Barbie, there are a lot of Hindi movies as well. Just the release of the promo of the SRK star Ghulam also came, and all of them look quite meaty. Would you think finally that PVR would be out of the woods and something that you should look at around 1400 levels?
First, the disclosure, we are shareholders of PVR, and I think every upside we're looking at exit opportunities. And the reason for that the habits have changed, and more entertainment is being consumed online. I would say through OTT platforms to an extent, even through gaming. So I'm not that positive on the prospects of Inox PVR. I mean, particularly also, when we talk to people, young generation, our generation, fewer and fewer visits are there to the multiplexes. I don't know how that's going to change as well. So I'm very negative on PVR Inox. It's not that the stock is actively valued at lower EV to EBITDA or price to earnings multiple. It's not that they are extremely high return on investment or return on equity as well, which justify high P multiple. And on the whole, I think they will find it very difficult to sustain volumes going forward also. And I think enough of this volatility in earnings as well. If you want to play the consumption entertainment theme, there are many other opportunities, and that's where we should be looking at.
Okay, appreciate you being candid there. That's the view coming in on PVR Inox. Meantime, Naresh, let's get in a take on some of these buzzing charts yesterday. Bharat Dynamics as well as a Cochin Shipyard.
So we've seen the strong momentum continue in the whole sector. Bharat Dynamics, after consolidating, took a little bit of a dip from 1200 plus level to 1100 and has again made a fresh 52-week high and all-time high. It's just that after a move of 10-15%, the risk reward is not great. So this would be still be on an avoid. Cochin Shipyard, on the other hand, still looks more interesting. The previous high for the stock was 680 to 700. From there, it corrected all the way to 430. And now has started making a comeback. The last high was 600 and it has crossed yesterday and made a move to 650 level. So on a fade off today to 610 to 620 would be a good entry point. Eventually the stock could cross and break out into new all-time highs. So Cochin Shipyard, out of all the names, still has a risk reward, possibility to take a buy on dips. The other names like Mazgaon Dock, etc. have been a one-way rally. Cochin Shipyard has a lot to catch up relative to the rest of the space. So a fade off today should be an opportunity to get into Cochin Shipyard.
Okay, and Kunal, what's your take regarding Lupin? Yesterday, towards the end of the trading session, we saw a bit of a spike coming in, given that the positive news flow regarding the Pithampur facility came through. But on the charts for Lupin and any other pharma name, even Piramal Pharma, because that's also seen a bit of a positive note coming in from pharma.
So I'll start off with Lupin, Nisha, because I think Lupin is a classical chart. I remember in 2022, on the time the results were extremely negative for the stock price, closer to 600 or 620 is where the stock bottomed out. There was a classical reversal which had happened. We look out for price reversals for Lupin, and from there, the stock has just gone through a very steady uptrend. Look at this one, the stock has not yet picked up pace in terms of the kind of battering the stock had seen 5 years from, I think, 1200, 1250 odd mark to a point where the stock dropped by 50% to come back towards 600 levels. So it's now seeing a recovery for itself. I believe that there should be more legs on the upside for this recovery for Lupin. I wouldn't be surprised that possibly in the next 12 months to 18 months, we could be looking at the stock coming back closer to that 1,000 plus, 1,000 to 1,200 kind of a target range for itself. So I'm extremely bullish on Lupin, and I believe that the recent recovery which the stock has shown over the last 6 to 9 months is something to probably expect from a long-term play. Other than Lupin, the other pharma stock which also looks attractive, in fact, yesterday we were discussing this extensively, was Sun Pharma, the stock confirming a breakout of multiple resistances around this 1,050, 1,060 odd mark. So almost like a triple top breakout for Sun Pharma, which is a very rare kind of a pattern, because typically triple top resistances, they act as more resistances or hurdles for the price charts. But this seems to be a breakout for Sun Pharma. So that's another stock which looks attractive. From the mid-cap pharma name, the couple of stocks which I've been very bullish on, Glenmark, pharma, I think at 650 to 660 plus mark where the stock is trading right now, again looks very attractive. The way the stock has moved in the last 6 to 7 months, breakouts on the charts on the weekly and the monthly basis, and even Zydus Life. On Piramal Pharma, on the other hand, because of the limited price history, I sense that the stock had fallen very sharply from 150, 60 levels to, I think, at point where the stock was at 50 or 60 rupees. So it's now getting into a recovery phase, Piramal Pharma. It's come back just around that 90 plus mark. So I believe that maybe some bit of more rally could be seen to the stock price. 100, 105 is what I would expect for Piramal Pharma, but because of the paucity of charts, difficult to forecast on a longer term basis.
No, fair, I take that point. Let me toss it to Dipan. I think he'll be better placed to answer that. Dipan, your view on Mankind Pharma, Piramal Pharma, if you track either of the names?
See, Piramal Pharma, I think, is doing a lot of catch up in terms of valuation, but don't really prefer the kind of business model that it is in. There are a lot of opportunities in other stocks as when it comes to contract manufacturing. And we want to companies which are more consumer focused. From that point of view, Mankind Pharma, I think, certainly looks very, very interesting, with 97% of the revenues coming from the domestic market, and they have a very strong position in their brands. Their strategy also is now pretty well appreciated, having focused on tier 2, tier 3. I understand from the industry sources that their average brands are 10-15% cheaper than the popular ones, and the kind of manpower they have on the street is quite phenomenal. So it's just a compromise on the valuation. So we're just waiting for the right point of time when Mankind Pharma will have that perfect margin of safety and risk return profile in favor of the investor. So I would say that our top pick within the sector has to be Mankind Pharma, a disclosure that we and our clients may be invested. And we would like to look at and advise as well to move, increase the exposure to Mankind Pharma. But I'd like to see this quarter's numbers to have a more firm and more convinced view on the stock.
All right, Dipan, good to have you on board. We've really managed to get in a lot of stocks, and thanks so much for sharing with us your views. Okay, a quick look at what the pre-open rates are indicating this morning. Flat as ever, no surprise there, at around the 19,470 mark, and for the Sensex were about 50 points. Let's get in those mid-cap calls then from our chartists. And Kunal, what's on your radar today?
So I'll pick up a high beta name over here. Avan and Graphite is something which looks attractive. In fact, the stock, Graphite, HEG, both of them, they've done reasonably well in the last 2-3 months. The stock has come back towards that 400 mark in the last 1 or 2 weeks. The stock has consolidated. So, when a high beta stock consolidates and doesn't go through a price correction, that's generally an indication that it's getting ready for another round of upmove. So I would be extremely bullish on Graphite from a short-term play. 450 as a target, stop loss at 96.
Okay, Nuresh, let's get in your top mid-cap call.
So that would be a buy on RBL Bank with a stop loss at 188 and a target price of 220. The stock has clearly been a strong trend from this higher top, higher bottom formation ever since it started breaking about the 155 mark. Now, the recent major high for the stock was around that 190-95 mark done in 2023 start. And even from the peak pre-COVID prices, the stock used to be 350 rupees. The stock is still down quite a bit. And from the lows of, it went all the way down to below March 20 lows. So structurally, such a move making a major 1-year high is an indication of a trend change and a stock which has survived the whole downslot. Out here, expecting this to slowly and steadily continue this move. So first target would be 220, but could surprise on the upside.
Okay, let's also tell you what else is happening outside the world of equity markets. And US lending giant Bank of America has agreed to pay as much as $250 million in fines and compensation They say that the payments are to settle claims around the bank double charging customer fee, withheld promise credit card perks and opened accounts without customer authorization. Also, OECD, or the Organization for Economic Cooperation and Development, has flagged off risks to jobs with the emergence of artificial intelligence. More than a quarter of the jobs that rely on skills can be easily automated in the upcoming AI revolution, says OECD. Now, they added that little evidence of the AI emergence on jobs so far has been felt since the revolution is pretty much in its nascent stages. Also, US President Joe Biden will be meeting Ukrainian President Volodymyr Zelensky at the NATO summit. In fact, the meeting will mark a sign of unity as Zelensky's attendance at the summit has been in question. Russia's war in Ukraine tops the agenda items for NATO leaders, along with discussing a future pathway for the war-torn country to join the alliance.
Meantime, the IMD has issued red and orange alerts for several districts of Himachal Pradesh. A flash flood warning has also been issued for some districts of the hilly state. The state has not seen such heavy rains in the last 50 years. Meantime, Google is celebrating India's favorite street food, Pani Puri, with a special interactive game Doodle today. On July 12, 2015, a restaurant in Madhya Pradesh's Indore achieved the world record for serving the most flavors of Pani Puri by offering 51 options. But if you're not into Pani Puris, let's talk about sports. Wimbledon defending champion Novak Djokovic continued his victory match as he took the challenge against Andrei Rublev to reach the semi-finals. Reaching his 46th semi-final, the Joker has equaled the all-time record of the tennis and Wimbledon legend Roger Federer. He's now set to meet Italian Jannik Sinner in the fourth final. In the final four, that is. The women's quarterfinals saw Ukrainian Elena Svitolina continuing her stunning comeback at the Wimbledon. Elena produced a major setback on centre court, returning shortly after giving birth to her first child.
Sharad is here to tell us why you should be watching out for all cargo.
Focus, we are having all cargo logistics, and what we are hearing from the street is that demerged entities are expected to be listed in the coming weeks. Now, the two entities which should be in focus would be the real estate business and the container freight business. And from what channel checks we are getting, the market share in the LCL segment, which is the less than container load segment, has already crossed 15%. Now, apart from this, importantly, the company is also participating in the non-deal roadshows. It's currently happening in the UK as well as Europe, and management has been very bullish, especially when it's focusing on the turnaround strategy after Gati's acquisition. Now, looking at the stock itself, the stock is up more than 37% from March lows. And also, Jefferies recently came out with this report valuing the company with a target price set at 370 rupees, with a valuation of FY25's P ratio coming at the multiple of almost 14 times. But there are important industry triggers as well as company specific triggers which would be in focus, and firstly would be that the global container freight rates, they are back to their pre-COVID levels, so that is something to watch out for. And apart from that, their MTO business, that is where the confidence is coming in, where the margins would be incrementally going up, and they are expecting that to actually sustain over the 6% mark.
Okay, there you have it. Thanks very much for all that, Khabar. Let's move on then to the index calls and find out what exactly our chartists are looking at. And clearly it seems to be a hold recommendation from Santosh, but majority is tilting towards no trade on the index. Do remember our chartists were saying that one needs to be very stock specific. Consolidation really seems to have kicked in. On the Nifty Bank, it's different calls. Kunal says buy, no trade from Naresh, and a hold call from Santosh.
Okay, let's revisit some of the pre-open rates and want to bring up Nazara as well as Delta Corp and see how they are settling into trade. It's a gap down even after the clarification that Nazara Tech issued to the exchanges, saying that they're not going to be as impacted by this new move on GST. Nazara Technologies now around 13.6%. And Delta Corp as well has gapped down by about almost 10% as we speak. What is PVR Inox up to? Let's see that as well, and whether or not it's seeing any movement on account of the GST on F&B now reduced. PVR Inox is holding up by about 3% as we speak right now. The big buzzer yesterday, of course, was Tata Com Polycab, IndiaMart, these were the big buzzers in trade yesterday from within the broader end of the market. And it continued to be Advantage Autos yesterday as well, with Maruti, Eicher Motors all holding out well. You also saw a rebound after day before's fall into Titan. And then ITC now with news of Sanjeev Puri's extension. That is one stock which is also holding out in trade and seeing a smart follow through to its price action yesterday as well. Kunal, two stocks, Tata Motors, ITC, in good stead?
Yeah, absolutely. I think for them, the trends are stable. So, Tata Motors also, over the last few days, we've seen some intraday volatility coming in where the stock dips down some 15, 20 rupees or 2-3% here and there. But then at the end, you see the stock recovering and then coming back and closing above the 600 levels quite comfortably. So, there's no cause of concern, at least over the near terms, in charts for Tata Motors. So has been a proven leader over the last 3-6 months of this price rally for itself, as well as over the last few weeks, where the stock has managed to stand tall and rise the supports for itself. Even for ITC, I think it's been a phenomenal chart. From 220 odd levels last year, the stock has come off quite significantly to those 450 plus mark where it's trading. In the last few days, there have been some interesting change of data points for ITC, where the 450 put a call option, which was actually a point where there was good amount of writing for ITC. And I think post the news flow which had surrounded the stock price, there had been a complete change where 450 call option from being a call writing hub has actually reversed its stance, and it's now become more of a put writing hub. So any dips closer to 450 mark would lead into a strong recovery for ITC. So I think 450 is now a very strong support for ITC. Any dips closer to that level should be taken as a buying opportunity. I would expect ITC to hit levels of 520, 525 in the next 1 to 2 months. And for Tata Motors, as I mentioned in the last couple of days back as well, I think 685 to 700 could be a nominal target over the near term.
Just wanted to highlight a few other stocks apart from Nazara Tech, which is tanking with a cut of almost 14%. Delta Corp 2 is down 10%, so watch out for that one as well. Let's pull up the pre-open rates if we can. As far as Nazara and Delta Tech is concerned, those rates should come up for you shortly. A cut of 14% as well as 10% on both of those counters. Pidilite is also on the back foot with a cut of around 2.25%. Citi has downgraded the stock, so we are watching out for that. You also have on the gaining side names like Mazgaon Dock. Yesterday that stock was locked in upper circuit 10% higher on account of the expectation of those Scorpion submarine order coming in. Today as well it's holding up with 4% gain. Sterlite Tech, wherein they have formed a partnership with one of the global companies. So that's also high by 3%. And then Medanta, Kalyan Jewelers are something which is on the front foot. Prestige Estate on account of that land acquisition as well as an upgrade coming in from HSBC is also in focus. Nuresh, the entire real estate pack, that's been a pillar of strength for the markets. Do you think that trend will play out for the rest of the year as well, or do you think the bulk of the rally is behind?
The trends are strong, but they need a pause. So DLF, the largest one, has gone up from 350 odd levels to 500, 510 levels. So that's a good 40% plus move. So some bit of a pause is needed. We could see a rotation in terms of different stocks taking a move in the real estate pack. So for example, even a Colte Patil, which was a sluggish stock, has gone up from 250 to almost 400 levels. But still the stock is at a new 52-week high. So overall the trends are positive. We need to wait for a pause and start looking at the names which have not done as well in the real estate pack. So something like a Soba, which has a lot to catch up given that the stock has gone nowhere over the last 2 years. That could be interesting. A Suntech Realty, which is a huge volume bump up after the recent correction. That could be another name which could be interesting. So now the spaces to be is stocks which have corrected rather than the ones which have rallied 40%.
Okay, just 30 seconds left to go before we kickstart trade for the day. And while it has been a bit of a consolidation market, yesterday you did see that mid-session spurt. And in fact, at one point in time, we were only 20 points away from that all-time high once again. So from there, we traced a little bit, but that's okay. We're pretty much in good stead. Even today, the GIFT Nifty is indicating a mildly positive start, but we're only inching closer to that 19,500 print once again in trade. 0.3% higher, that's what the pre-open rates seem to be indicating. While, of course, one fraction of the market, the GST sensitives would be in focus. There's lots others as well that we're going to be looking out for. The Nifty then, 19,490, just 10 points shy from that 19,500 print. Let's see what Bharti is up to. Remember, they've acquired that additional 20.6% stake in Lavelle Networks. So that stock is in focus, and yesterday itself, it clocked a 52-week high. There's also ITC. The board has approved Sanjeev Puri's reappointment as CMD for 5 years. Good smart move on ITC. 476 is where that stock is. Now, of course, let's get to the news specifics. I want to see what Delta Corp and Nazara Tech are up to, considering it's a 28% GST, which is going to be levied on full value for online gaming casinos with no distinction between skill. Coming in right now, 10% lower for Delta Corp as we speak. Wasn't anticipating anything different. And I think it's a gap down even for Nazara, even though the management has clarified that they're not really impacted by this 28% GST, which is slapped. Nazara also lower by 9% as we speak. For what its merit may be, it's also marked PVR Inox, considering the GST on F&B has now been reduced to 5% from the earlier 18%. 2% higher for PVR Inox as we speak. 1450 is where that stock is. Havells, they forayed now into electronic manufacturing services space for ACs and washing machines. So look out for that stock too. There's Lupin, wherein the US FDA has cleared the Pithampur unit 2. They've issued an EIR as well, although this news came in during the fag end of the market hours yesterday. Wipro, they've launched AI 1360, looking to invest about $1 billion in AI over the next 3 years. Marginal uptick on Wipro. And then, of course, let's check in on the result contenders. What is HCL and TCS up to ahead of their earnings today, though post-market hours? Mildly positive for TCS, HCL absolutely flat. But I don't think the market per se is giving you any reason to complain. In fact, if nothing, we're pretty much in line with the rest.
Actually, all the sectors are in the green, barring autos, which is on the back foot, and it's M&M and Maruti, which is seeing a bit of a profit booking. Rest of the sectors are comfortably in the green. It's the metals pack which is taking the charge yet again today. Pull up a JSW Steel, a Jindal Steel, GSPL, Ratnamani, NMDC, Tisco. All of these stocks are higher in the trading session. Though I have to say that Nazara is actually bouncing back from the opening tick that we saw. So it started with a cut of almost 13-14%. Now it's showing a cut of just 5%. So there has been quite a bit of recovery from the intraday lows already. The management did clarify that this only impacts 5% of their revenue. Can't say the same about Delta Corp. As we were highlighting, it continues to be locked in the lower circuit, a 10% cut coming in there. Pidilite, the city downgrade is weighing on that counter, a 3% cut. IndusInd Bank, wherein Soumit was highlighting that it's not getting added into the MSCI index yet, so the flows might reverse a bit. That's seeing a cut of almost 2% as well. And separately, what else is buzzing on the gaining side? Mazgaon Dog, there was a large, I think, that happened on it because the volumes are on the higher side, 5% higher for that one. And then Just Dial Kajaria Ceramics, wherein there has been an upgrade which has come from Goldman Sachs, is also higher by around 2 to 2.5%.
Yeah, PVR, Inox, we talked about that 5% rate being put. A sentimental positive rub-off is what you're seeing on the stock. And yes, individual names like a Varun Beverages or a Nippon Life, LG Equipment, those are a buzz in trade. Let's get in our chartist stake then. A positive market breadth and holding out around the 19,460 mark. Kunal, your take, given that still it's 19,500 that it's eluding us, and what's your first trade?
Yeah, I think we're still consolidating on the Nifty as well as on the Bank Nifty, but I think the attractive trade over here would actually be a long on Bank Nifty because most of the indicators are actually going into an oversold territory now for the banking index. So I think that's where I would probably keep an eye on, and any kind of an intraday dip, specifically if it happens for the banking index, should be taken as a good buying opportunity. Now, the stock which I would be clearly looking out for in the opening trade would be HDFC Bank. The stock again has gone into a mild correction in the last couple of trading sessions. Indicators are into an oversold territory or entering into an oversold territory for HDFC Bank. So that's a trade which looks very attractive.
Naresh, what are the first trades that you're punching in?
So Ashok Leyland looks interesting. The stock is coming in that touching distance of 170, a breakout, and the last 2 days of strength out there, expecting this breakout move to continue higher.